Hey guys, my name is Ruben Nuts, and I figured I might as well go live into the closing bell because, well, why not, right? I already got started. And so, for those of you who don't know me, I've been trading and investing in the markets and
Hey guys,
studying them
my
and
name is Ruben Nuts, and I figured
all of them, for over 10 years. And so, I might as well figure I would go into the closing bell and talk about. I just talked about silver. For those of you guys who missed it, I did just talk about silver and basically why I got into silver. And I guess we'll go into a quick recap of that because I don't think there was that many people that watched it live anyway. And so a big reason why we did the silver live was because in context of volatility, it has to do with the way they move in the upside whenever the markets are uncertain. So I'm going to go ahead and share this screen just to explain to you guys why, because all in all, we should talk about the metals because they are moving up quite a bit. So if you can see here, first and foremost, the reason we're going to look primarily at out of the money option calls or puts, maybe buying puts, is because in these uncertain market conditions, trading futures or forex, there could be wild moves in the aftermarket. There could be slippage. We obviously saw a lot of circuit breakers in the previous quarter, and so with buying the vertical put spreads, usually the risk reward is not ideal for these particular market conditions, but we can look at that as well. If you buy the futures, obviously you can lose a lot more with the slippage and all of that, and then with you can buy the stock outright, but then you have the overnight risk. But then with the options, you're pretty much buying the risk up front if you're just straight buying an option. And so for that reason, I did want to hedge my portfolio because I am alongside the equity markets. You guys who know me kind of know that I'm a big tech trader, and we've accurately predicted a lot of the tech moves pretty much since the inception of my channel. And so the reason I like to trade the tech or just the equity markets is because they tend to go up, right? So although I do trade supply and demand when it comes to trading in general, when it comes to the equity markets or options, I do not trade supply only because the markets are tend to keep on going, right? And so when you think about the futures market or or commodities like the oils, like and the golds and those things, they do tend to respect supply and demand a lot better in my experience because of the way that they are used to hedge, right? And so whenever you think about the markets in terms of um, just the way they move and the way they're designed to go up, the opportunity cost can be just as expensive, if not more expensive, than than missing out on the trade, right? And if you think about going to economics, there's no free lunch. That implies opportunity cost and missing an up move. Statistically speaking, if you miss the top 10 trading days between 95 and 2005, you would miss um, if you held through those few crashes, you would have north of 450%, I believe. If you miss the top 10 trading days, that would be cut to more than half, at around 200 and something percent. So we don't want to miss up moves. But when it comes to the gold and silver and commodities, they are different. So with that said, because of the way we are designed to not only hedge our portfolio, but potentially by a specific breakout, we can see that the gain from 1970 to on the low of 1980, between those, gold had an up move of 2,300 percent, 2328, while silver had an up move of 3,105%. The fall from 1985, uh, uh, between 1980 and 85, the high and the low, the fall for gold was 66%, silver was 89%. The gain from '08 to the low to the high of 2011, gold went up 166%, while silver went up, 440%. And then the fall from 11 to high to 2016 low, gold pulled back 44%, while silver pulled back 71%. So gold is more volatile, but in this specific scenario, because of the goal of hedging a portfolio and also capturing an up move, the silver was going to be a lot more conducive for this specific trade. And so from that, we bought into whenever gold was trading at, or silver was trading at $14, we bought a $24 strike. We spent about 100, or I spent about $191. It is now worth over 1,600. I cashed some of it out as it hit supply. And so I'm going to go over the logic of that trade just very quickly so we can set the precedence for supply and demand for those of you guys who are new to my channel, and then kind of go from there. So we're going to go to SLV. We're going to look at the daily time frame for this one. I don't want to explain it a ton. I just want to get the point across that it is primarily based on price action and not technical indicators. So we consider the markets to be the inverse of what we actually want to see, because the markets are rather um, are like a photo negative, right? What we're seeing here are the filled orders. Meanwhile, what moves price is the unfilled order. So we got into silver at around $14 at that point, about the $24 strike call. And the reason I bought so is because we were seeing at the last time such breakout happened, as it was moving up into this point of purchase in the up gap. Last time that price was here in 2011. So I'm going to go ahead and go to the weekly candles only to showcase you guys what just happened. We can see that when price was there, it had this 200 and something percent up move. And then let me remove all of these actually. Um, remove this trend line, remove this trend line, or let's just remove all trend lines. Okay, so I'm just gonna redraw them because that'll just be a lot faster. So when we were at what was it, 14 here, around here, last time that this happened, it broke out, and so then the logic was to buy a potential breakout, and then whenever, so this is a 3 times leading indicator. The primary leading indicator is supply and demand. The second one is looking at the ahead of the flip, the third one being the uh, capturing the best risk reward ahead of that flip in terms of those zones. So at that point, the flip that I am referring to is basically this. If you're an OTA student, or if you know supply and demand, you kind of know what I'm talking about. If you don't, it's basically whenever a high is tested, and then it flips into becoming the low, as it did here. It tested here, and then this became the new floor. Oh, I guess you're probably familiar with that. So then with this potential 68% up move and this 226% up move, there was plenty of risk reward upon a flip to be captured at that strike price. And so then thus the 10-to-1 risk reward was acquired. My primary positions at this point are silver, neo, and I have some USO, as you guys saw a little bit earlier. And so again, this is really intended to see kind of how the markets correlate. So for those of you guys that are looking at metals, we're going to go ahead and oversee the gold, which has been the big talk of the town because they hit 2000, the futures contract. And so now I'm going to uncorrelate these charts only so to show you guys the correlation between gold and silver. And we're going to go to the same, obviously, time frame. So let's go to the daily. And as you can see here, they are very, very correlated. So then the next thing that matters is the percentage up move and the risk we're wanting to acquire. Another reason why is because if you're so now I'm going to go into the possibility of buying gold versus silver during this time, because if we look at gold right now, and let's go now to the weekly candles, we are pretty much at an all-time high when it comes to GLD. So there's not a huge flip opportunity like we saw here for silver. Part of the reason why I did not get into gold and I stuck to silver instead, because and the second reason is going to the futures, or going to the options, excuse me. Here, going to the options layout, that's not what I was looking for. Here, going to the options layout, if we look at the GLD at the money strike is $10.40. So that the fat of that, the extrinsic value of that, you're paying $10 for, as opposed to silver, the at the money for the same expiration, because it is priced at a lower rate. The money of that is let's cut this to silver. Add the money for the same expiration is $3.25. So it's a $600 difference with a potentially better risk reward, and not at the all-time high with no supply. And again, this is a commodity market. So with that said, that is why we decided to go into gold, because or silver, excuse me, because all things considered, risk reward and percentage moves, it seemed as though silver has a better up move of with that being considered. So with that said, let's go ahead and look at the Nasdaq, as we are expected to obviously see a lot of these earnings. And so going back to something that I've always said, but it's more important to remember than ever, is that the opportunity cost is just as expensive. Whenever we think about there is no free lunch or there is no free meal, that really refers to the opportunity cost. And so, for example, I got into Tesla at around 175. I got into Nvidia at 135 and Apple at 145 in the last 2 years. And I cashed those out at supply because the institution that I wanted to believe what knew better than I did said that it was at supply and that we should be cashed out and the market was going to crash. Well, you cannot predict our market crash, and thus the opportunity cost became a lot more expensive than the education, because right now my account will be worth over $1.2 million if I never knew what a supply zone was as it pertains to the equity markets. So what we can do instead is have rolling options and what have you, which I will go into in a different video. My point to saying that is that an opportunity cost is very, very expensive. And if we begin to think in terms of opportunity cost, we will be a lot more financially successful, usually speaking. So with that, let's go ahead and look at, let's link these up again together. And one of the, obviously the FANG are the biggest market movers here. So um, I'm going to group these two windows so they synchronize, and this is going to be daily. Well, no, this will be actually 15-minute, and I'm going to make this QQQ stock, and I am going to make this daily. So a few things to consider here is obviously the Federal Reserve is significantly influencing the market right now with how they've pumped, or even just the idea that they're willing to do so has been a significant influence. So we can see here, however, that the Q has outperformed the S&P 500. I don't think I need to pull up a chart for that. I think we all know that because of the way that working from home is kind of the future. So the reason I wanted to pull up the 15-minute chart is because it's important to note how things report ahead of earnings, or even trading the news, and what oftentimes that could look like. I'm debating whether I should open up my Thinkorswim charting, because I don't know if you guys can see this too well on the live stream on YouTube. Let me know in the comments if you guys can see this okay. Otherwise, moving forward, I'm just going to start using Thinkorswim because it's a lot more visible for you guys. But let's look at some of the biggest market caps. So let's begin with Apple. And something that is often also important to notice is the way that the way buybacks work, right? So if companies can only do a certain amount of buybacks by certain hours, if the market is significantly moving during that time in that direction, that's safe to say that the big companies are actually doing buybacks, which could be a big indicator as to what to expect from earnings and just the markets in general. So looking here at the 15-minute, we can kind of see we're at 438, and so things have been going pretty much sideways and more or less of a consolidation here from the third, it looks like. So let's zoom into this chart. So from August 3rd, so pretty much this week, it's pretty much been sitting here ahead of earnings. And the same can likely be said. I'm going to unlink this again. And we're just going to be in the 15-minute because we're going to talk about earnings. And let's look at the Qs. And this is another reason why it was important to get into an inverse correlation like a gold, or even something that is outside of the equity index markets, something that we can, and I'm not going to go over it in this video, but we can see how the different commodities may have responded in the case of a correction, in terms of which even commodities to get into and for a proper hedge again. So because of the current market conditions, because these are mostly out of the money calls, the most I can lose is how much I pay up front for it. So because I'm already up over 50 times what I paid for with the Neo calls, getting in at 15 to 27 cents, and then getting a good amount out at $10, as I did in a previous video before, that is well over 50 to 1. Nothing that could happen in the markets could possibly bring me back to my baseline of the profitable. I think over the last month, my return has been about 25 or so percent. And so so with that, because we are in that even playing field with out of the money, because of the current market conditions, nothing can happen that's too crazy that's going to cause a significant loss. With that said, though, having out of the money calls with, or now in the money, excuse me, for both silver and Neo, again, why it's 2 times ahead of current market pricing. Now we can kind of look at potential plays to get into different sectors. So let's look at the percentage move and see what's been moving. This is another one of my hedges, is commercial real estate that I have puts on in case of a cataclysmic And part of the reason is because, well, it's not a tech company and I am long tech. I'm short pretty much, not short everything else. I wouldn't actually short the market, but that's my long. Everything else I'm neutral about. And so with my expectation for commercial real estate, and I pretty much looked at uh, the way that SPG is leveraged, or the Simon Group, uh, how much they can afford, how many months they can afford without paying rent, and their not only with their P&Ls, excuse me, but the price to earnings, or their earnings, debt to earnings ratio, and equity. And so for that reason, it's part of the reason why I wanted to, if I was going to hedge against a crash, I wanted to do it with SPG. And so, and it was Fargo because I believe it's the weakest bank, and there's been so much scrutiny with them already. If I was going to short something, again, I like to short the weakest things within specific sectors if I'm going to hedge. But even then, I am very careful with going against the market or even just buying puts. And so with that, then we can see that the biggest movie here is Disney, which ironically, from what I remember, reported really bad earnings, but it's still moving on the upside. And again, these things are just really gasoline for price action, and so I don't know that this is really worth looking into. But I think it's safe to say that Disney was really pending a breakout. And they have the streaming and all of that. I do also suspect that if this streaming revenue continues to go on the upside, it will be considered then a streaming or a tech company, which could dramatically shift the way it's priced. And so that's something worth noting that I can go over in a different video here with um, Disney. So another ones that I like to look into, for example, just we did like silver and gold, are AMD and Nvidia, right? I'm a big fan of both, and I wish I kept my AMD at $14 now being at $85. And looking at how these are moving, we can kind of see here how, let's just look at them in comparison. So let's look at NVIDIA and let's look at AMD. And if you guys want me to look at any specific stocks, feel free to put them in the chat. All in all, you can see the exact same correlations, and then the question becomes, what do you want to control? The best risk reward and the percentage up move from supply and demand. Again, I scratch supply when it comes to the movers into the techs, or the equities. So what could give me a favorable risk reward? So right now, there's nothing I'm too crazy about. So going over the earnings here, looking at Apple historically, what something that is interesting that to me seems like the market sentiment could be either or, whether they're going to want to have a pullback for more buying in or a hit at supply, is because it is consolidating, where oftentimes ahead of earnings, you can kind of see it going one way only for earnings to make it move a swing the other way. So yeah, this is interesting. Even the 1 minute. So again, I think right now my favorite is to get into the something at the money, and NVIDIA. And something we can go ahead and also open up a new window is to look at, again, kind of like how we saw at Disney. It's really just gasoline for the fire. So gasoline for price, excuse me. Looking at the Nasdaq. So because it is kind of uncertain in a way, or there's not a clear direction during this market condition, we can actually begin to look at the futures market. And being that the Nasdaq has cleared pretty much a major quarter and is hovering over the 03, I think it's safe to say that I think it's safe to say that we can take it to 11,250 with earnings, with the supply zone or demand zone, excuse me. Let's go into the 4-hour. Oh, this was the last one I drew. Let's see. Let's get in closer. So our last demand zone worked here at 10,375 to catapult to 11. And so it's important to note how these move. I feel that the NQ futures respects quarters really well. And so again, being that it's really, let's look at whether it even tested a 25. So it did test 34. So given that it did test 34, let's look at the 1 minute. So the high was what, 28? So it tested the quarter and it cleared the quarter quite a bit. I think I honestly, I do think it's safe to say that we can see the Nasdaq going to 11,250 this these next few days. Or it could let's see, let's go to the 4 hour. I mean, it's just all of these have so many buyers and buyers coming in. Even on the 1 hour. I mean, honestly, unless it was going to test, when was this? 731. Unless it was going to test 1070 or 10750, I presume. No, I think it seems it could potentially rip. So in this particular scenario, let's look at some potential longs, and we can even do some potential longs. I'm looking at some potential puts, and so let's look at the options chain for the Qs. And this is one where you can consider doing the weekly, or no, but let's not do that. You always have the option of the obligation to close out early. So my rules for me personally, I always go 3 months out at least. So 270. So you can see the open interest here at 270. Add the money is 1K. There seems to be a good amount of 4,000 at open interest at that's 265. And I do like to look at open interest for thought, but here we can see, yeah, 296,000. Even let's look at other open interest for different months. 300. Yeah, with 300, it would be in par with, if we do the conversion, 250 would be $30. There is not, you guys, this market is not very bearish. I mean, there are some puts here. And obviously there's iceberg orders and all of that, but 255, which is $15 below. What is that? Let's look at 71. QQQ. And let's look, and this is where I do like to look at percentages. So so the open interest here is at 255. That is nothing. 6% for 5%. A 5% is where there's a lot of open, a 5% pullback. Is there a deeper one? No, everything pretty much indicates everything pretty much seems to indicate bullish 260. Oh, there's some good, there's a good amount here at 260, which could be vertical puts sold, but 260 is what, again, it's a couple of percentage points, and the break even for that is 13. So what is that, 240, 275? These, I'm gonna say these are probably vertical puts, just looking at the break even. So all in all, this is pretty bullish. With that said, looking at the text, looking at how everything is quite bullish, looking at the big movers, an opportunity that I think we can begin to look at is maybe an AMD. Depending on your account size, that could give us a decent risk reward. Let's see, Microsoft. Interestingly, though, the biggest percentage mover right now is Disney, which is not a tech. Not yet, at least. AMD and Q. I would say maybe some out of the money. So let's look at the Q out of the money calls. for or at the money. Otherwise, something that is not in the hundreds of dollars could be a Neo that you consider buying. I got into it way long ago, so I don't know if I will buy it all over again right now. Something you can look into is AM. Let's look at AMD. Oh dang! Let's look at AMD compared to. Sorry, I'm just having fun here. AMD, it looks to have moved a lot more exponentially than Nvidia, actually, even though Nvidia gets a lot of notoriety. This is from 6/29/2020. From 6/29/2020 to 8/3. This is an 82% move. What is this? 5. Are we looking at the same? 6, yeah. So six. It must be this one. 40. I mean, that's twice the move that then in percentage points. Then and again, what matters at the end of the day is going to be the percent, because 10% of $10 is $1. 10% of $1 million is $100,000, but your return is going to be based on the percent on a dollar amount, right? And it's important to remember that when you're trading, especially when you're doing, well, no, all trading, but definitely with options. It's interesting, yeah, because something we're consider buying is maybe calls and puts. And something to remember too is Apple's cash, right? And it's something also that's always worth noting, because if we go into, let's just look at that really quick. But it's something to consider, because if Apple, I think last time I checked, it had a good amount of its market cap sitting in cash. I mean, then no matter what happens, it can't be totally affected unless the dollar also collapses. So let's look at Apple Cash. Apple market cap in cash. Apple market cap hits 1.6 trillion, and how much do they have in cash? Sitting in cash. 2.2. So out of it, so it has about 20% of its value sitting in cash, right? And this is as of 2020. Oh well, this is, let's look. So let's look at January, April. It's just I have plenty of cash. So April. This used to be the latest one. So Apple and cash has, and this from Stock News. And again, we can do a deeper, more thorough due diligence here. But I mean, if we go from the beginning of the year, it has about. So I don't know that COVID changed a ton of that. I think I would presume that if anything, they probably have more in cash now. I just an assumption. I could be wrong, but you know, if they have 20% of its value sitting in cash, that's worth considering. When and that's where fundamentals do matter. Like, let's say in contrast to like a Microsoft, right? Like how much companies have sitting in cash, and context of evaluation could go into analyzing the P&Ls, the risk reward, and the profit targets, especially if you're looking at the way institutions are investing and trading these things. And these are not really complicated concepts, guys. Like, this is something that, you know, if Apple and Microsoft both worth $1 trillion, and one has 30% of its value in cash, the other one has 20% of its value in cash, that's an easy calculation to make, you know, when it comes to the valuation and the way things are weighted. So with that, looking at Apple options right now, Another cool thing about Apple being especially out of the money calls is like if you do get assigned, sometimes it can be very favorable because then at that point all you're doing is rolling puts just to protect yourself. Um, so 439 for 40. Um, it did hit a pretty clean quarter for 40.50, or at least with the 50 part and the round 40. Um, and I think Apple already reported, excuse me, but looking at the overall tech sector, it's worth noting kind of how different things are doing. Um, and with Apple being one of the biggest movers, I think it's safe to say that we're going to see um, that. So let's look at 439. Gosh, these are so inflated, guys. They're so inflated. Um, I don't see anything I love. I don't see anything I love. Um, Here, let's look at a vertical put maybe. And again, I do trade vertical puts opposite to everyone else. We can look at a vertical put in Target. So see the put, if you sold it at currently is 450 and then you took in 40 in credit, your break even then becomes 410. And then if you were to cover at 410, your break even at that point, that might not be horrible actually. New window. Um, I am going to open up the options chain. No, it's not the options chain. It's I'm going to, let's see. So where would our target be? So see, the thing is, we are at all-time high. So if we were to sell the four, what has the most? Yeah, let's say here, sell strategy. Oh, let me turn on the strategy builder. That's what I was looking for. So if we're going to sell this, oh, this just moved dynamically. Um, and then cover at around our break even. No, that sucks. Uh, what is Amazon doing? Is there anything? Is there any specific stock you guys want me to look at? Let's look. Okay, let's just look at the biggest percentage movers. Again, I'm pretty much locked into my trades. And I usually trade like a flagship or like 3 or 4 a quarter. I don't day trade all these random things. Um, that's how I got the 400 and something options return last year, 70% of the account, or 60 or something like that. And then this year, going that direction as well. The VIX, well, yeah, the VIX is down. Biggest up move is Disney. I mean, that's worth noting. I do feel like it's going to be a tech valuation sooner than later. I know someone was looking at Starbucks. We already talked about Starbucks. SPG, as I said in the video before, this is my head. Like this commercial real estate. Yeah, I'm not super bullish. So again, if anything, I might be considered then at this point looking at the NQ futures. So I just wouldn't hold. I just wouldn't hold over the hour close or over the weekend. So I hope this video was helpful. Let me know what you guys prefer to see in more detail and if I should switch platforms. So thank you guys so much for being here. Love you guys, and I'll see you guys next time.